Good morning. This is live daily market outlook for Wednesday, 4th of July 2012, prepared by Windsor Brokers. Rather quiet markets in past 1 or 2 days, as most of investors are awaiting the ECB's meeting tomorrow, when some action is expected. For now, the European Central Bank is likely going to cut the interest rates to a record low on their tomorrow's meeting, but may need to do more to satisfy financial markets already starting to wonder about the solidity of last week's summit measures to tackle the Eurozone crisis. The steady inflation and the dire batch of economic performance indicators, also including signs of weakness in Eurozone top economy Germany, give the European Central Bank cover to back up the EU summit deal with a quarter-point cut in its benchmark rate to 0.75%. The ECB has never cut its main refinancing rate below 1%, but policymakers say there is nothing to stop them doing so, and they may want to bolster Eurozone leaders, even if they never admit to such quid pro quo deals. At the summit, the president of European Central Bank, Mario Draghi, strolled into the middle of the media zone to declare his satisfaction with the agreement to speed up cross-border banking supervision and to allow the Eurozone Rescue Fund to recapitalize banks directly thereafter. The meeting is due tomorrow, and the markets are in rather quiet mode as single currency stays within a very narrow range in the past 48 hours, similar to the other instruments, except the crude oil that is actually the top winner of past few sessions, as it broke our initial, our break point at $87 per barrel. That was seen as a break point of the recent dip and posting the double bottom at 77.50-20 zone, with the sharp recovery now looking for more upside movements after breaking this important technical point. From the other side, the oil remains well supported by fundamentals and news, as the weak global economic data boosted basically expectations for more monetary policy stimulus, while also the top mover of the oil in past couple of days is rising tension over Iran's nuclear program, and the world's worries about disruption in supply. As said in our yesterday's session, Iran has issued a warning and basically sort of a directive that should be closing the Strait of Hormuz for any Western directed oil tankers in order to retaliate in a way the Western world that imposed the strict sanctions that are already giving effects, as most of Iranian consumers are countries from the Eurozone, as well as East and the Far East, with the China and India being one of the top consumers, and the reduction in the imports from Iran is already affecting the already weak Iranian economy. Also, the military exercises in Iran in past 2 days, where the Iran said it had successfully tested medium-range missiles capable of hitting Israel as a response to threats of attack. The further increasing tension between the Tehran and the rest of the Western world, and the increasing risk on further raise of the oil prices. As said, crude oil, American crude oil for August hit a level at 88.00. This was the highest so far in the late hours of yesterday's session, with the technical outlook being still quite positive, and the fundamentals, of course, very supportive for the oil. For today, as we have the Independence Day in the US, not much action, or at least some reduced movements. Speed in the movements is expected at least during the afternoon hours when America will be shut, but in Europe still a lot of action to be seen. From today's calendar, we have a number of services PMIs due to be released across the Europe, apart from the data already released from Far East, with the Australian retail sales for May showing improvement comparing to the negative figure of the April's release at -0.2%, and the forecast for today at +3%. Release was +5%. China's services PMI also dropped. 52.3 is the release of today compared to 54.7 for the May's release. Also, the series of PMIs from Germany, Eurozone, UK are forecasted at equal or lower levels. The Germany one kicks at 7:53 GMT. 50.3 is today's forecast compared to 51.8 of May's release. Eurozone PMI is expected to stay unchanged according to the forecast in June at 46.8, while market services PMI for from UK for a month of June is expected according to today's consensus at 52.8 to drop compared to the May's release at 53.3. And the last one from Europe is the retail sales for May from Eurozone at 9 o'clock GMT. -0.8 decrease is seen forecasted for today compared to -2.5% of the release of April. Then that would be all from the calendar, and we're going to take a quick look now in the markets. As said, not much action seen in the past 24 hours or so, as the markets remain in the rather quiet mode, awaiting the decision of ECB. That is the main focus for tomorrow, and also the release of U.S. non-farm payrolls that are due on Friday, is the first Friday of the month. These are the two main things that are going to be drivers of the markets in the coming days. As said, the euro is still in the consolidative sideways mode with the range defined on the downside by 125.60 and the upside 126.26. Yesterday's peak significant is the point that 126 zone, despite yesterday's spike higher, remains intact for now, as is also defined by descending main bear trend line of 132.82 through 127.45 peak. And as long as 126 level stays intact, the risk is seen still more towards the downside, keeping the downside more vulnerable. Studies on the hourly chart are in the are flat in the negative, in the neutral mode, while 4-hour chart ones are sideways, slightly aligned towards the downside, as the pair attacks initial dynamic barrier 125.80, the 20 days moving average ahead of 125.64, which is the 55 days. One loss of which would be a signal that also marks the range floor. That will be a signal of further extension of the short-term, near-term, reversal of 126.90. However, important to mention also that upside remains well limited initially at 26, and more significant barriers at 127 and 127.45, and basically only break above these levels would provide relief. The studies on the daily chart are still more turned towards the downside, as loss of momentum after unsuccessful attempt to regain 127 barrier now sees more risk towards the downside, as the price moves again below the main bear trend line to 132.80 to 127.45, increasing risk of possible test of interim supports. 125.50 is the 50% retracement, and the more significant is 125.20, 125.00 break point. We have the previous peak at of 28th of June. 61.8% retracement, and round figure support that will be triggered for more significant losses and extension towards the next very significant and strong support at 124.00 that marks the short-term base. As said, only regain of 127 level would provide relief, and the open way towards next very significant and strong barrier, double top at 127.45. Similar to Euro, Sterling remains in the sideways mode, but near-term tone is still slightly aligned towards the downside, as unsuccessful attempt to clear 157 zone despite two brief breaks to 157.20 did not give any more significant results, and the pair seems to be losing ground in the near-term action after European opening today, with initial support being tested now at 156.60 zone that is marking the near-term range floor, ahead of trendline support at ahead of the main bear trend line of 163.00 through 157.76 that currently stands at 156.36, and the 156.40 low of 2nd of July 2012. Basically break of these levels and 38.2% retracement at 156.30 will be signal of fresh weakness with the next significant level seen at 156.00 and the 155.75, 50 and 61.8% retracement respectively, break of which to accelerate losses and open way towards more significant supports. Main bull trend line currently at 155.20 zone and 154.84 low of 28th of June 2012. The 4-hour chart studies are still in the positive territory, but slightly turning towards the downside, with loss of 156.00 support required to confirm negative near-term tone and allow for the further weakness. That will be also signaling the lower top at 157.21 against a previous peak at 157.76. I would say the key points at the downside are trendline support at 155.20 and the 154.84 low. That will allow for some a deeper reversal, as the upside remains well limited for now at 157.20, 157.50, where is the 200 days moving average, and the only break above this level and the spike high at 157.76 on the 20th of June would provide relief and signal stronger recovery of its recent low at 152.67 posted on 1st of June 2012, as the pair so far retraced 50% of initial 163.00 to 152.67 down leg, where the gains were firmly capped by 50% retracement, reinforced by descending 55 days moving average. The dollar yen seems to be losing traction, as several attempts at 80.00, our break point, did not result in any success, with the pair moving below 80.00, with the recent low seen at 79.50 as initial support, and 79.60, pardon, and 79.50 the trend line support, break of which would be again turning the tone into more negative territory. 4-hour chart studies are in rather neutral mode, as the pair remains within the 79 and 80.00 range, and the basically break of either side would define the short-term direction of the pair. More vulnerable downside there remains more vulnerable for now, as barriers at 80.00 and 80.60 are still capping the upside, and a possible break below 12.79.00 and the 200 days moving average at 78.91 would be signal of further weakness, as the upside on the daily chart was so far limited by descending 55 days moving average, and keeping the more pressure towards the downside. Loss of 79.00 and 78.91 would be will be bearish with the immediate support seen at 78.60 ahead of key short-term support at 77.65 1st of June low. On the upside, a regain of 80.00 and a firm break above this level would ease the current downside pressure and automatically refocus upside target at 80.60, peak of 25th of June 2012. Also, the previous double top of 2nd and 16th of May 2012. And Swiss franc also, along with the other majors, holds the sideways mode, moving within the narrow range of 95.11 and 95.60 after brief corrective bounce of 94.62 low of last Friday, stayed capped by 95.62. This was the highest seen so far. Neutral tone is seen on the hourly chart studies, while the 4-hour ones are still more into the negative territory, as descending moving averages, immediate one 95.45, 20 days exponential moving average, and the 55 days one at 95.58, along with the previous peak at 95.62, keep the downside for now limited, with the studies still in the negative territory, seeing more action towards the downside. The upside is also so far limited. Pardon. The upside is so far limited by 38.2% retracement at 95.50. This is by basically reinforcing the current barrier. I think there is a mistake. The upside is the upside barriers are reinforced by 50% retracement at 95.70, and basically only break above here, and the more significant 96 zone, where is also 61.8% Fibonacci retracement, is required to provide the relief and allow for some stronger corrective action of 94.62. Daily structure is more negative despite regaining some momentum, but unable to break above the broken bull trend line of 90.41. Sees more risk towards the downside, as daily 20 days moving average at 95.50 is also limiting the upside action. Basically, we need to see the break above 95.60, 96.00 in order to signal some stronger recovery. Otherwise, loss of 95 break point would be more bearish, and look for a test initially of 94.61 and the more significant double bottom at 94.20 seen on the break below 95.00, 94.60. And a quick look at the top performer, crude oil, that made significant progress after very strong losses seen in the past 2 months, after the price dipped from 1st of May peak at 106.41 to 77.27. This was low of last Thursday. A strong recovery now confirms the double bottom pattern at 77.54, 77.27 as the pair. That's what we mentioned in our yesterday's session, where the oil price initially regained the 85.80 level. We were looking for a break above 87.00 to confirm. So far, the oil reached $88 per barrel. This was the peak of yesterday, with some corrective action now seen on the overbought near-term studies, as 1 and 4 hour indicators are now started pointing lower in the corrective action. 87.00 is already lost as initial support, with the more significant one seen at 85.80 previous resistance now acting as support, along with some Fibonacci levels, 85.47, 23.6%, and the previous peak at 85.28, high of last Friday, ahead of 83.90, the 38.2% retracement. I would say the risk, a big risk would be seen on loss of 82.50, 82.00 zone that will turn the focus again towards the downside. For now, ideally, reversal above 84, pardon, 85, I would say, would be seen as ideal for resuming the current short-term recovery of 77.27 with the next levels seen on a firm break as 90.00, 89.28 and the 90.00 as seen as the next targets ahead of 91.84 that marks 50% retracement of the broader 106 to 77.27 down move. And basically a brief look at the gold that basically didn't manage to the gold that broke above 1600 the level and extended so far to 1624 ahead of our more significant barriers at 1633 and 1640. Positive tone continues to dominate on the short-term studies. However, MACD bullish divergence seen on the hourly chart sees the possible risk of a possible reversal, stronger reversal towards the downside. As you can see, the uptrend was clearly defined, but MACD failed to follow up this level, and this increases basically risk. So far, the pullback is seen on the overbought near-term conditions, and the immediate supports are standing as follows. The first one is at 1607 and then 1600, which also marks the 23.6% retracement and ascending 55 days moving average, and this is quite a strong support for the this reversal ahead of more again a significant one at 1595. That is a higher low of yesterday, and the 38.2% retracement. Risk will be seen on loss of 1585 as only the higher low of 2nd of July, as well as 50% retracement. That would again weaken the structure and turn the focus lower on the upside. Immediate barrier 1624, yesterday's high, and 1633 and 1640, a break of which is required to allow for some stronger recovery and avert immediate risk of revisiting a critical support zone at 1530, 1520 and 1500. That was all for today. Thank you for being with us. We're back again tomorrow with more stuff, more interesting actions seen in the tomorrow's and Friday's action, as we have European Central Bank rate decision, and Friday the non-farm payrolls from US. So we're expecting more action in the markets, as most of the instruments are currently in the wait and sit and wait mode, awaiting the action of European Central Bank. As said, we're back tomorrow morning at the same time, 7:00 GMT. Until then, I wish you a nice day and successful trading. Good luck.